This session looks at the sales mix and sales quantity variances. In the same way that the materials mix and material yield variances are used to help break down the materials usage variance further, we can use the sales mix and sales quantity variances to break down the sales volume variance and dig deeper into the reasons for an adverse or favourable variance. We will look at the calculations that need to be performed to find these variances, and we will consider reasons for the variances being adverse or favourable, as well as demonstrating the relationship between the sales mix and sales quantity variances and the sales volume variance. The sales mix variance looks at the proportions of each product actually sold compared to the proportions we expected to sell when setting our budgets, and the sales quantity variance looks at the difference in the contribution or profit generated by a change in the sales volume of each product compared to budgeted sales of those products. The sales mix variance is calculated as the actual quantity of each product sold, minus the total quantity sold based on the standard mix, multiplied by the standard contribution or profit per unit. This is basically the same formula as for the material mix variance, but instead of using standard cost per unit of material, we replace this with standard contribution or profit per unit. Alternatively, we could state this calculation as what we did sell compared to what we thought sales of each product would be using the standard mix, multiplied by the standard contribution or profit per unit. We use contribution or profit per unit rather than just the selling price per unit, as we need to take into account the differences in the variable costs associated with each product as well. A product with a high selling price might sound like a better option if we want to increase our profit, but if the variable costs are very high as well, then it might be better to sell a lower priced product with low variable costs, as this might generate more profit for us overall. By comparing contribution figures per unit, this issue is dealt with within the calculations. Let's demonstrate this with an example. Biscuit & Co Limited make and sell two biscuits, the cookie and the bar. Sales of the cookie are forecast to be 5,000 units, and sales of the bar are forecast to be 8,000 units. The standard mix is therefore 5 cookies to 8 bars. The contribution generated by each is 50 cents per cookie and 40 cents per bar. Actual sales were 4,900 cookies and 8,500 bars. The sales mix variance is found by comparing what we did sell with the same total volume of 13,400 units, but at the standard mix of 5 cookies to 8 bars. This gives us a standard sales mix of 5,154 cookies and 8,246 bars. We have therefore sold 254 fewer cookies than under the standard mix, and 254 more bars than under the standard mix. As for the material mix, you will notice that the differences are equal and opposite, and this will always be the case with the sales mix and material mix variances. Applying the standard contribution to these differences gives us a variance of $127 for cookies. This is adverse as we have sold fewer than per the standard mix, and a variance of $101.60 for bars. This time this is favourable as we have sold more bars than per the standard mix. The overall sales mix variance is therefore $25.40 adverse. It is adverse because the figures tell us that we have sold fewer of the more profitable cookies and more of the less profitable bars than we would have done under the standard mix, and therefore we have made less profit overall. The sales quantity variance is calculated in a similar way to the material yield calculation. We take the actual quantity sold in the standard mix proportions, the same figures we have just used in the second column of the sales mix variance calculation, and compare this to the forecast sales, and then multiply the difference by the standard contribution or profit. Again, we use contribution or profit rather than selling price to take into account the differences in variable costs in each product. If we use the same example as before, we can see this in action. The total volume sold in the proportions of the standard mix is 5,154 cookies and 8,246 bars, whilst the forecast figures were 5,000 cookies and 8,000 bars. This gives rise to a difference of 154 cookies and 246 bars. In both cases we have sold more than forecast, so the variances will be favourable. The variances are calculated using the standard contribution of 50 cents for a cookie and 40 cents for a bar, giving $77 favourable for cookies and $98.40 favourable for bars, and therefore an overall favourable variance of $175.40. The overall variance is favourable because we have sold more of both products. Both products generate a positive contribution, and therefore profits will be higher than forecast. So now we just need to prove that the total of the sales mix and sales quantity variances equals the sales volume variance. We know that the sales mix variance in our example is $25.40 adverse, and the sales quantity variance is $175.40 favourable. So the sales volume variance should be $150 favourable. If we calculate the sales volume variance using our normal approach, we will arrive at the same figure. Remember that the sales volume variance is calculated as what we did sell compared to what we thought we would sell, multiplied by the appropriate standard contribution per unit. In this case, we did sell 4,900 cookies and 8,500 bars, whilst we thought we would sell 5,000 cookies and 8,000 bars. So we have sold 100 fewer cookies than forecast and 500 more bars than forecast. If we apply the standard contribution figures to these volumes, this gives us an adverse variance of $50 for cookies and a favourable variance of $200 for bars, and a total volume variance of $150 favourable, just as before.